Hey YouTubers, welcome back to my channel. For those of you that are new here, my name is Sai. Now, some of you might be thinking, well, Sai, you spent a lot of time on your hair today. Well, I actually just went to the barber's and thought I'd record the video with the feeling like I just went to hair and makeup. Now, in today's video, I thought I would explore a well-known secret about stock investing. Now, this is usually only known with the investing world, and amateurs like me and probably you don't usually find out about this. The big secret is basically a market cycle that continually occurs over a period of time. Now, you may have heard about market bubbles. This is where the market gets driven up in value from investors driving the stock price above the actual current value. But a bubble is just one of several market phases, and to avoid being caught off guard, it is essential to know what all the other phases actually are. So, while the intro video plays, why not smash that thumbs up button? Because I've been told that YouTube will recommend my video to more people, and also that will then mean that more people watch my video, and then hopefully I'll get more subscribers. So head down and hit that like button. So, understanding how the markets work is one of the first steps to do in order to get a good grasp of realizing how the market cycles should affect the way in which you invest. So first of all, what is this market cycle I keep going on about? Well, basically, it shows trends or patterns that emerge during different markets or business environments. And using past history, it becomes quite evidently clear that during various parts of the market cycle, certain groups of markets end up outperforming other groups. Now, from the most basic terms of a cycle, the ones with two wheels, a bicycle, the fundamental aspect is that the cycle, or more importantly, the wheels, goes round and round in a full circle. And then it starts all over again. And the same applies here in the stock market. The phases are cyclical. So there are rises in the market, then there are peaks, and then it starts to dip, and then they completely bottom out as well. And once one market cycle finishes, the next one begins again. Now, the majority of investors or traders fail to recognize the market cycles, or they just forget to expect the end of the current market phase. But at the same time, it's nearly impossible to pick out when a cycle is at the top or at the bottom. But understanding the cycles will help maximize your returns. So what I want to do today is help you understand the four major components of the market cycles, so it can also help you recognize them as well. Now, phase one is the accumulation phase. Now, this phase occurs after the market has completely bottomed out, and then the innovators and early adopters begin to start buying stocks, as they have realized that the worst is over. And at this phase, valuations are very, very attractive, and generally the market sentiment is still quite bearish. Now, usually during this time, the media is busy preaching doom and gloom, and novice investors usually get scared of the market value dropping so much, and they end up giving up and selling off all of their holdings. But one thing to remember is that when people are selling off their stock, there is also people ready to pick it up at a healthy discount, which essentially helps drive the market from a negative sentiment to basically a neutral one. And then we have phase two. This is the markup phase. Now, this is where the market has been stable for a little while and is beginning to move higher. Now, this is usually when the majority of people try to jump onto the bandwagon. So investors usually see that the market is having higher lows and higher highs, therefore identifying that there is a change in market direction and sentiment. Now, during this phase, the media starts to discuss the possibility that the worst is over, but unemployment is continually on the rise, and there are usually many layoffs in many sectors. But then at the same time, investors start to experience the feeling of fear of being in the market is much better than the fear of being out of the market. And so they just decide to take a ride on the bandwagon. Now, this is also usually the time when investors on the sidelines miss the biggest increase in the market. So eventually when the prices begin to level off or the markup phase begins to slow down, the sideline investors jump back in and cause yet another parabolic move upwards. Now this basically leads the sentiment of the phase to move up from a neutral to a bullish and in some cases a very euphoric time. Which brings us on to the third phase. Now this is the distribution phase, and in this phase, this is where the sellers begin to dominate. So this is when the bullish sentiment of the markup phase begins to turn into a more mixed sentiment. So this is where prices can often stay locked in a trading range that can last a few weeks or even a few months. But then after that, the market reverses in direction and it is normal to see double or even triple tops in the market. This is a very emotional time in the market as well, as investors are gripped by times of complete fear, alongside with hope and even greed, as the markets start to seem like they are going to take off again. Now usually during this time, the market sentiment is actually quite slow, but they are sure that it will actually change. But then this transition can happen quickly and can easily be accelerated by a strongly negative event or extremely bad economic news. And then finally, we have the markdown phase. Now this is the final phase and also the most painful for those holding onto positions, because this is where many investors who hold onto their investments decide as the markets fall below what they had already paid for, and they start thinking whether now is still a good opportunity to keep holding that stock. Therefore, a lot of investors decide to cut their losses with their investments and take a hit of maybe 50% from the value of which they initially paid. Now this point in the cycle is usually treated as like a buy signal by early investors, and it is a sign that the markets could bottom out again. Therefore, this is when new investors come in and usually buy a depreciated investment and end up enjoying the next markup phase. Now, the biggest question out of all of this is, how do you time the market cycles appropriately? And this comes down to the question around what type of investor are you? As a cycle could last from anywhere between a few minutes to a number of years. Now the reason for this is whether you're a day trader who uses 5-minute bars. This could then end up seeing 4 or more complete cycles within a single day. Whereas, say you're a real estate investor, you could see cycles that could last 16 to 20 years. Now on top of that, we're currently in a US presidential election year as well. So there is also a presidential cycle where every 4 years the stock market, real estate, bonds and commodities are affected in some kind of way. Now the theory here is that during the first 2 years of a president's mandate, there are usually economic sacrifices that are generally made as part of their campaign. Also, the year of election usually sees a decrease in interest rates, and obviously this year we are experiencing even further unsettle with a global pandemic, and so the interest rates are at the lowest rates that we have ever seen, therefore allowing companies to borrow more money with less risk and therefore pumping more money into the stock market. However, this also introduces a false view that the markets are getting better before an election, which then also means that there's a likelihood that the market collapsing after this period as well, especially because of the increasing worries of the second waves of a global pandemic. Now another thing to keep aware of is this graph, as typically the stock sectors have a cycle that overlaps with the economic cycle. And as we can see in the stock market cycle, and as we can see in the graph, the stock market cycle precedes the economic cycle very slightly. Now, at the end of the day, it's not always obvious what phase that we're actually in on the cycles, unless you truly know what type of investor that you are. Now, personally though, being a long-term investor, I'll be sticking to the advice that I've had of continually investing into things like index funds, with the hope that history will be in my favor and that in a 10-year period, I'll be better off with my regular monthly investing in the S&P 500 and like the FTSE 100, while also keeping a little bit of cash in my portfolio in order to buy into any lucrative options that emerge during these uncertain times of the near future. Now, As I always mention, I'm not a financial expert in any means, and I have no financial background. So all this information is just what I have gathered together from my own research. So before you invest in anything, I strongly recommend that you seek professional investing advice from maybe a financial advisor. But that's it for today's video. I hope you enjoyed it, and I'd love to know what your plans are towards investing during this uncertain times ahead. So let me know in the comments down below. And if you haven't already, make sure you subscribe to my channel and hit the bell button so you get notified when my next video comes out. And as always, make sure that you like the video, comment down below, and share with your friends and family. See you on the next video. Bye.